All right, let's dive into one of the biggest rules in all of finance and business strategy: diversification. It's this core idea that promises safety by spreading out your risk. But, as we're about to see, it's not always the silver bullet everyone thinks it is.
I mean, you've heard this a million times, right? It's the simplest way to think about diversification. It's just common sense, this timeless piece of wisdom that says, hey, spreading your bets is just a smart thing to do.
So is it? Well, yes and no. The idea itself is super simple, but the actual science behind it, that's where things get really fascinating and a little complex. Because knowing how to do it is one thing, but understanding when and why it can completely fall apart, well, that's the real secret to managing risk.
To really get a handle on diversification, we first have to figure out what kind of enemy we're actually fighting, because it turns out not all risks are created equal.
Okay, so you've got to split risk into two main buckets. In one corner, you have unsystematic risk. Think of a single company messing up a product launch. It's specific to them. In the other corner, you have systematic risk, like a huge recession that hits everybody. And here's the absolute key. Diversification is your shield against the first kind, but the second one, that's a storm every single ship has to try and weather.
This right here, this is exactly the kind of risk diversification was made for. If one company in your portfolio totally bombs, it doesn't have to sink your whole investment. By owning different things in different industries, the bad news from one corner gets balanced out by everything else. And here's where we hit the wall. When the whole market gets rocked by something massive, a global crisis, a pandemic, it almost doesn't matter how many different stocks you own. Pretty much everything tends to fall at once. This is the kind of risk you can't really escape. Okay, so let's get into the nitty-gritty, the science behind how spreading things out actually works. Because this isn't just some old folk wisdom, it's a full-blown, Nobel Prize-winning idea. So, back in 1952, an economist named Terry Markowitz comes along with something called modern portfolio theory. He's the guy who took that eggs in one basket idea and turned it into a rigorous mathematical framework that completely changed how we think about investing. So, how did he do it? How do you turn common sense into a science? The magic isn't just about picking safe stocks. Nope. It all comes down to one single powerful concept: correlation. He figured out that it's not about how risky each investment is on its own, but about how they move in relation to each other. And this is the genius part. The math shows that as long as two assets don't move in perfect robotic lockstep, combining them will always reduce your portfolio's overall risk. Think about it like a seesaw. If one side is up while the other is down, or even if they just move a little differently, the ride gets a whole lot smoother. The less they move together, the bigger the benefit. But what happens when that fundamental role just breaks? Because even a strategy this powerful has an Achilles heel, and it has a nasty habit of showing up at the absolute worst possible time. Just think back to the big ones, right? The 2008 financial crisis or the 2020 pandemic crash. When panic hits, investors stop thinking about good versus bad. They just sell everything. Stocks, real estate, you name it. All these things that are supposed to act differently suddenly nosedive together. Yeah, there is a name for this. It's called a correlation spike. It's that terrifying moment when diversification pretty much stops working, right when you need it the most. All your carefully separated baskets suddenly get roped together as everyone rushes for the exit. And hey, this isn't just some dusty old history. We've seen it recently. Even the classic, super safe 60-40 portfolio, that's 60% stocks, 40% bonds, has struggled. When inflation gets high, rising interest rates can hammer both stocks and bonds at the same time, which kind of blows up decades of conventional wisdom. Okay, so this whole idea isn't just for Wall Street. Nope. Massive corporations play this exact same high-stakes game, and we're talking billions of dollars on the line. But for them, the logic is a little bit different. So companies usually diversify in one of two ways. There's related diversification, which makes a lot of sense. Think of Disney buying ABC. They're leveraging their expertise in content. Then there's unrelated diversification, where a company just buys up a bunch of totally random businesses, creating a giant mashup called a conglomerate. And here's where it gets really interesting. You'd think investors would love that kind of safety net, but they often do the exact opposite. Study after study has found that these big, sprawling conglomerates often trade for way less than they should, somewhere around 13 to 15% less than what their individual parts would be worth on their own.
This is famously called the conglomerate discount. It's basically the market shouting, hey, I can diversify my own money much better and cheaper than you can. Unless you're actually creating some real synergy here, you're just making things complicated and destroying value. Oh, and the history books are filled with some truly legendary flameouts. Take Bic, the masters of cheap, disposable pens and lighters. They decided to launch disposable perfume. But perfume is an emotional luxury buy. The brand just didn't fit, and the whole thing was a spectacular failure. And it's the exact same story with Harley-Davidson. Their whole brand is built on this image of rugged, rebellious freedom. So when they started slapping their logo on things like bottled water and cologne, customers just couldn't make the leap. It completely violated what the brand stood for. Okay, so what do we do with all this? Let's bring it all together and talk about how you can think about diversification in a smarter way, whether you're an investor or running a company. It really boils down to 4 key rules for being more resilient. For investors, it's all about the first 2. Look for assets that truly move differently from each other. And then be disciplined enough to rebalance your portfolio regularly. And for companies, it's the other 2. Demand real, tangible synergy for any new move, and make darn sure that it's a perfect fit for your brand.
All right, so let's do a quick recap. Diversification is a fantastic tool for getting rid of company-specific risk, but it's vulnerable when a market-wide crisis makes everything move together. For companies, it's got to be about synergy, not just collecting businesses. And for investors, it's an ongoing process, not a set-it-and-forget-it decision.
And that brings us to one last big question. In a world that's more connected than ever, where financial shocks can circle the globe in minutes, what does a truly safe or uncorrelated asset even look like anymore? That's the challenge we're all facing now.